Let's get to today's action. The major averages closing mostly higher as yields pulled back. The 10-year yield firmly below 4.4%. The Russell 2000 getting hit hard, though, falling more than 1%. Joining us now is Vital Knowledge founder Adam Crisafulli and HSBC head of equity strategy Nicole Inui. Welcome to both of you. Adam, what's this with the yields being in check, but the Russell not doing so well? That's not what we're used to.
Yeah, I think markets are really grappling with, the path forward here, where we've had now for 2 days in a row, we've had, economic data that is pointing to a slowdown in growth with the manufacturing ISM yesterday, the JOLTS report today. And so, yields are falling, which is positive for equities, but I think now investors are grappling with what this means for the outlook on earnings. So cooler growth, disinflation, and outright deflation, corporate pricing power is starting to wane. So all that creates earnings headwinds. So the headline indices traded well today, but like you said, the Russell was very poor. And then a lot of the big cyclical groups, so capital goods, materials, energy, banks, all of them were big underperformers today, suggesting that investors are growing more concerned about the outlook for the economy. We've been used to, for the last several quarters, anytime yields went down, that was kind of an automatic positive for equities. But that narrative is starting to evolve now as investors start to be more concerned with the outlook on growth and earnings versus simply focusing on the level of yields.
Yeah, real estate, the best performing S&P sector. Nicole, it's a market that's caught in this range, it seems, reacting to macro still. You don't think inflation is easing enough for us to count on more than one cut this year. Is that dangerous for these markets with the consumer perhaps slowing?
Well, we have the call that we expect one rate cut this year. The market's pricing in almost 2 rate cuts. Again, we've always had the view that the narrative needs to be that the next move for the Fed is lower, not higher. Yes, I think on the consumer side, we are seeing some pressure. So if you look at delinquency rates on credit cards and auto loans, those are creeping up. They are above pre-pandemic levels, but of course, they're far from what we saw during the great financial crisis. But we are seeing that creep up a bit. But I think on the economic side, what we need to see is this mixed economic data that we're seeing. So we're seeing a cooling labor market. We're seeing activity surprises for U.S. growth churn, so they're actually declining. But that's also because expectations for GDP, for growth for the U.S. has risen substantially. So I think what we're seeing in terms of the mixed data on the economic side, inflation that's sticky, but it's cooling down. We think that will set the stage for one rate cut. We think that's enough for keep the equity markets rallying at this level.
Yeah, Nicole, though, economic conditions are only ever mixed at the macro level. For individuals, for any individual family, it seems like they're pretty defined. And it seems like for the majority of families, if you're facing inflation that's not coming down as quickly as one would hope, but a pinched picture for your discretionary spend, that's not great. So, I wonder how much that plays out in PVH. They already warned about their consumer feeling pinched. Are there places where you're looking for signal and ways that investors should play it if this continues to play out as it has?
Sure. On the consumer confidence side, we saw a dip in April. We saw it coming back a little bit in May. We're seeing, mixed commentary from companies. So you're seeing some companies saying that they're seeing improvement in discretionary categories. You're seeing other companies that are saying that the consumer's wallet is still pinched and that you're seeing some consumers trade down. So what we see in terms of the consumer side, we do like consumer discretionary and consumer staples stocks.
Okay.
But what we've always said is that you need to be selective. I think the high-end consumer continues to do well with equity prices very high, home prices very high. Most of them are in these fixed-rate mortgages. So, those sort of stocks that play to the high-end consumer. And even on the low-end consumer, where we are seeing pressure, I think what you're seeing is some of the middle-income consumers trading down. And so what you're seeing is some of these consumer companies actually seeing the ability to gain share in those markets. So these are kind of the pockets of the consumer you want to be positioned in on the equity side.